Have you ever wondered how a seemingly contradictory jobs report can completely change the narrative of our economy? Well, then you must have seen today's job report. The numbers came in, and they're shaking up the headlines. Job creation is underperforming, while wages are racing ahead. It sounds like a plot twist in an economic thriller, doesn't it? Well, let's dive into why. Picture the economy as a giant engine powering a bustling country. Every month, new jobs are like fuel injections that keep this engine running smoothly. But today's report shows that the fuel injection isn't as strong as we'd hoped. The headline numbers for job creation are softer than expected. This slowdown in new jobs could be the first hint that our economic engine might be decelerating. Fewer jobs mean less spending power on the streets. Imagine fewer people bustling in shops, dining out, or even going and driving to work. Consumer spending, which is the lifeblood of our economy, could be facing a slowdown. Yet, there's another twist in this story. While new job creation is cooling off, those who have jobs are earning more. Average hourly earnings have come in hotter than expected. Think about it. Even as fewer people are being added to the workforce, those who are employed are seeing their paychecks grow. This tells us that despite the slowdown in hiring, the labor market is still having pockets of intense competition where wages are on the rise. Now, why does that matter? Because when wages rise, companies then pass on those increased labor costs onto their consumers. It's like the price tag for your favorite coffee shop suddenly going up because, well, the barista's earning more. This wage growth, while good for the workers, adds fuel to the inflationary fire. In a world where job creation is decelerating, but wages are climbing, inflation may stick around longer than we'd like. For investors, this creates a complex landscape. On one hand, slower job growth might signal that economic momentum is cooling, potentially affecting sectors that rely heavily on consumer spending. On the other hand, persistent wage inflation means that the pressure on prices isn't going away anytime soon. This dual risk, slowing economy combined with stubborn inflation, is a challenge. It forces investors to reconsider how to position their portfolios. Speaking of volatility, let's turn our gaze into the stock market. Companies that face higher wage bills may see their profit margins squeezed, especially if they can't pass those costs easily onto consumers. Imagine a tech company or a retail giant trying to manage rising labor expenses without losing its competitive edge. And if job creation continues to slow down, consumer spending can falter, further impacting company earnings. This uncertainty can lead to choppy waters in the stock market, with investors constantly reevaluating risk and reward. Now, what about the interest rates? Here's where the plot thickens. The Federal Reserve, much like the captain of our economic ship, is caught between a rock and a hard place. On one hand, they have softer than expected job creation that might suggest that there's room to cut rates more frequently this year. But on the other hand, the wage growth signals that inflation remains a big challenge. This creates a policy dilemma. Should the Fed try to stimulate the economy by keeping the rates low? Or should it continue to fight inflation by keeping rates elevated? Really think about that question. And now ask yourself, what would you do if you were the Fed? It's not an easy question to answer. But if you were to ask me, I would think that the Fed is likely to maintain these level of interest rates in the near term. Despite the slowdown in hiring, the strength in wage growth indicates that inflation isn't ready to take a back seat yet. So expect interest rates to remain at these levels for a while and force investors to navigate an unpredictable market. To sum it all up, today's job report tells a mixed story. While the pace of new job creation is slowing down, a potential sign of a cooling economy, this continued strength in wages is a reminder that inflation remains stubborn. For investors, this means staying alert diversifying your portfolios, and being prepared for a market that may experience both volatility and uncertainty in the coming months. If you like this kind of content, please like and subscribe. And with that said, thanks for watching, and until next time.